Hey guys, what's happening? Hope you guys are well today. So in today's video, I wanted to talk to you a little bit about trailing stop orders, and I just wanted to give you, a basic opinion on what I think of them and how I don't use them, why I don't use them personally. But this is an interesting topic. So I did make a video a while back on stop orders, how to use a stop order. This is going to be a little bit of a follow-up on that. However, I do plan to make a video in the future that covers a few more important details regarding stop orders. All right, guys, so if you're into this stuff, leave a comment on the video, like the video, and subscribe to the YouTube channel. So basically, this is the concept of a trailing stop. So the market is trending and you buy. So let's say you buy it here and you're gonna place a stop, somewhere down here. All right, so that's where you limit your losses. The reason why people use a trailing stop is essentially because they want to be locking in profit as the market moves in their direction. So when the market continues to trend, generally you'll continue to move your stop, and the cliche thing is to move your stop right under the swing low, basically. Now the problem with this is that the market, I guess I'm relating this to today's market conditions mainly, okay? The market looks for liquidity. So the problem with a trailing stop is gonna be this. You're gonna get into a swing low, you're gonna move your stop up, then the market's gonna trend lower, take out your stop, and then shoot up higher. And unfortunately, this right here is the type of behavior that happens more these days. That's why, in my opinion, trailing stops don't work for the way I trade personally. And that's why, again, opportunity is in the eye of the beholder. From a trading standpoint, I'd be happier getting on board with this sort of move as a stop run and scalping a few points out of the market, and then being comfortable getting out and watching the interaction when the market stops out those weak traders who all put their trailing stops right under the swing low, and then, like I said, watch the interaction and then assess the situation from there. Let's create that scenario again, but in the other context. So let's say the market is trending lower and you decided to enter a short position and you placed your stop above this high. You sold here, you got a decent entry, and you got your stop here. All right, so maybe you got a good entry and now the market is trending lower. All right, so you decide to move your stop here. Now, the problem with that is, say you're going right into the 930 open and that happens right here. Normally, the market's trending lower. What happens is you'll get a nice pop, take out your stop, trend a little higher for a bit, and then boom, the sellers come back and you weren't on board for that move because they sold it so fast before you could say the word sell, the thing was already trading down here. So I'm just trying to explain to you certain scenarios where a trailing stop would fail, and there are certain scenarios where a trailing stop would work very well. We can get a little bit technical here. Okay, so there are some trades where a trailing stop would make sense. So let's say your market's coming from a down move and we start to have a bit of this consolidation. We try for a leg down and your volume profile looks something like this, where you have a high volume node in this area and then you have lower volume here. So we'll get something like this, we'll get a pop, and then all of a sudden you'll start to see the sellers losing their steam and we're starting to bid higher, and then you start to see this type of thing where we're one time framing up and you're basically going back to an area of high volume. So this is an example where a trailing stop might work because in a sense you're trading against the move of the market. What you're doing is you're fading a move back to the high volume area, which is something that happens quite often. And essentially, if you get in here, you got a decent entry, and if you're profiting from this upside, you may as well trail a stop, because in my opinion, this method would be categorized as something more of a short-term approach. In this case, I would argue that a trailing stop would be a decent option because of the fact that, remember, you are fading a move back to a high volume area. So there is still a risk that sellers can enter before we get to the high volume area and smash it back down for a lower low. So if you manage to catch some of this upside and you see that the sellers are dry, that might be a good opportunity to trail a stop. So again, I'm just kind of giving you some scenarios here. I'll give another completely different scenario now. So let's change the color back to red. Let's say the market's kind of trending higher, but it starts to enter a bit of a trading range, and our volume profile looks something like this. And then up here we have a lot of volume that's traded here. So our market popped up the highs and now we're kind of back in the range and we get something like this. Let's say you were a trader looking to sell this market, because this area corresponds to an area that you would like to become a seller in the market for whatever reason. So what's normally going to happen is you're going to get into the short. Maybe you got in here, or maybe you got in here. This move right here is going to stop out weak traders. So if you got into the short here and then you put in your stop immediately, guess what? You're getting stopped out right here. And guess where you're getting stopped out? Right at the high volume area. At that point, if the market is truly biasing to the downside like you expected, you'll probably start to see this. And when we start trading lower, guess what? You're going to get this again. If the bias to the downside is still valid, normally it'll get rejected and you'll go for a lower low. However, this right here is something very important. What this is, this ugly drawing here, is essentially a very typical pattern of price movement that markets tend to do. This is not any form of trading method. This is not any form of advice. I'm just simply explaining to you market tendencies and price movements and how trailing stops can work in certain scenarios and how they can't work in other scenarios. All right, guys, this was a little bit of a short video. I wish you a great day and take care. Bye.